Brought to you by runtogold.com, the premier source for monetary science applied to geopolitical, international, and economic, financial news and events. Welcome back to the 37th episode of the runtogold.com podcast. I have with me Aaron Crown, who's the founder of Mortgage Lender Implode, which is found at ml-implode.com. Hi, Aaron.
Hey, Trace.
How you doing?
Doing pretty good here in sunny, sweltering, but very dry Vegas.
Yes, it is.
It's a change for me.
It is. It's pretty warm out here. So can you tell the listeners a little bit about what your website does?
Well, the website is basically Collapse Central. That's ml-implode.com, or you can go to mortgageimplode.com. And it has an emphasis and focus on the real estate market, the U.S. real estate market, but tracks things connected to it and wider economic ramifications to what happened with the mortgage crash and credit crunch and all that. And we keep track of the latest goings-on and the debate around what happened and why and what should be done. And the site consists of a lot of different modalities. There's news syndication, where we just post links to news. You can get feeds of that. We have our own in-house bloggers, such as Rolf Winkler at Option Armageddon. And we have forums, the Implode Explode forums, actually. So that the whole network is called Implode Explode, or implode-explode.com. And we have forums common to all our websites, which includes the Bank Implodometer and the Builder Implodometer and the hedge fund implodometer as well.
Which is really interesting, because my tagline is kind of, the system doesn't collapse but evaporate, and they're all exploding and evaporating into nothing. And your site's also the central one in the industry, right? You've been on all types of national news, and you get all types of traffic with it.
Right. As far as the mortgage industry, very early on in 2007, the site was basically adopted by the industry because people in the industry needed to know what was happening to them, whether they'd have a job the next day, whether they'd have, whether brokers would have lenders to send their business to, which lenders would still be around. So we became the leading source for change in the industry. And as far as those who are left in the industry, I think we still have very much that same role. And there are many others, of course, who follow the site as a way to just follow the latest with the collapse and possibly aspects of renewal.
And of course, you come with a little bit of background in Austrian economics.
Right. I actually studied math and computer science, and that was my profession. But at the same time, I was, since probably really before the dot-com bubble crashed, I started studying economics and finance on my own. And after the bubble crash, I took a more contrarian tack to try to really understand what happened, how there could be such a great calamity and what was really going on. So I got into more and more Austrian reading, through Lou Rockwell and all the other writers there, and Financial Sense and those sorts of sites, and Mises.org. And he supplies a great education, of course, and went off into all sorts of great books by the various great Austrian writers. And I don't see how anyone can understand the macroeconomy without understanding the nature of money and credit and their true role in facilitating economic activity, either or impeding it, and the government's role in manipulating that.
And once again, it's the Austrian school that has the vision of the future. They're the seers that are able to see what's going to happen, see what caused it, why it happened. And as we were talking about over drinks at the Wynn last night at the Parasol with that there's a giant frog that came up out of the waterfall and started singing to us. It was pretty funny. But over dinner we were talking about the effects of interest rates. And see, under the Austrian School of Economics, we look at the business cycle, and the role that interest rates play is in regulating production over time. And so what role have we seen past, present, and also what you see going into the future with regards to commercial and residential real estate, and what the central banks have been doing regarding interest rate policy?
Well, it's very interesting how that all works. And in the last few decades, we saw more and more gearing of the economy into what some people, such as Eric Jansen, have been calling the FIRE economy: finance, insurance, and real estate. And as part and parcel of that, Fed policy and things like the GSEs and other organizations, government organizations or quasi-government, became more and more geared towards making sure the spigots of credit would freely flow to those areas. So they became more and more governed by that intervention, and ultimately susceptible to being, overblown, as we've seen. So obviously they can't really bring back that bonanza by lowering interest rates and channeling liquidity through the GSEs in the way they were. However, they've switched to new modes of forcing the money into the system and forcing credit into the system. So, for example, they've taken the GSEs into conservatorship, or they basically, there's probably not much hope they're ever going to spin them back off to be quote-unquote private entities. So, but what they're doing is not only keeping them alive and propping them up, but the Treasury and the Fed, through TARP money and quantitative easing, are actually forcing credit through the husks of the GSEs that are left. And they're buying not only the GSE's own bonds, but buying MBS, mortgage-backed securities, through them. And they're even, they actually are just going to start, as we reported on our site last week, they're going to start re-securitizing old Fannie and Freddie debt that they would otherwise have to hold on their books that was going to be hopeless, and they're going to actually sell it, which means they're going to sell it to the Fed. So the Fed is going to start buying off the old debt. So there's really an air of desperation to keep definitely the residential real estate market going. And, of course, if you just print money and give it to people, you can get them what they want. You won't necessarily fix the sector. I doubt they'll even be able to reverse the home price decline. They may just slow it down somewhat and drag out the misery. But as far as commercial real estate, what they've done there is interesting as well. That's basically driven by what the major banks are doing, the major and regional banks and lending consortia are doing in terms of lending into the commercial real estate sector. And the dynamics there are a bit different because it's unlike residential, where it's impossible for the banks to really look at millions and millions of mortgages and figure out what loss they should take and whether they should even bother helping people. And so they really haven't. With commercial, you have a smaller number of entities that they can just say, okay, we'll give you another 6 months, we'll give you another 6 months. And they can do that now because of all the Fed liquidity facilities and TARP and all of that, and the retrenchment of fair value. So they basically, the banks have been cut so much slack that they've been able to cut slack to the commercial real estate sector. So that basically, I think that's been on life support essentially for over a year, 1 to 2 years. It usually follows residential with about a 1-year lag. This time it has taken longer, and I think it's because of the immensity of the bank bailouts. So what is all of this going to achieve? Well, it's slowing down the crash, but the cost of that is to not only perpetuate the dysfunctional system, but increase dependence on the Fed and the central planners, and drag out the misery. I mean, we're going Japanese, full-fledged, full bore, in contrast to the lecturing that we gave the Japanese over the last decade. So it's pretty pathetic and sad, but that's what they're going to achieve, I think.
Well, exactly, as we read in America's Great Depression by Rothbard, the first thing that the government should do to intentionally exacerbate the Greater Depression is to prevent the liquidation, to prevent the credit contraction. And that's
Right.
exactly what they're attempting to accomplish with these bailouts and the TARPs
Right.
and TALFs and other craps.
It really is shameless for them to rail against the practices and how bad these banks are, but then berate the Financial Accounting Standards Board for wanting to move towards
mark-to-market.
And it should clarify for the readers that mark-to-market was utilized extensively on the way up, because they could mark into an expanding bubble. They could mark their profits immediately with very questionable values
and get their bonuses.
And then abscond with those. Well, on the way down, they don't want to do it, and so that's why this has become a big issue. So those who say that mark-to-market is the problem, well, you have to pick one, you either don't do it on the way up, and then you don't have to do it on the way down, at the cost of being less transparent, which is going to be bad. I mean, investors are going to figure out that there are problems with what banks are claiming unless you do this. So that's the option. And
and when I was in accounting school, Accounting 101, the chief purpose of the accounting statements is to provide comparable financial statements. And so when you don't have this mark-to-market and you don't have the clarity and the transparency, you can't have comparable financial statements. And so then what can you believe? And
it's a bit mysterious to me because I think that the financial standards organizations, they had a pretty good system. It was abusable, but you could tell if hanky-panky was going on here. They had the level 1, level 2, level 3 subdivisions, and you kind of knew what was going on. It was, if Goldman Sachs was putting lots of assets into level 3, you could ask those questions, and the market could do what it needed to do, which is to punish them for abusing that. However, just telling them that that you don't even have to do that, basically, is just ludicrous.
And all of it, eventually all of this trickles down to the individual. And as we were walking through the lobby of the Bellagio, we saw the residential sales office for the condominiums. Remember that? And so, what do you see for a city like Las Vegas, where we have all of these high-rise condominiums going up, and we have all this construction that's happening? What do you see happening for cities that were on the cusp of the bubble?
Right. Well, the cities that were very much geared to the bubble economics are in a serious world of hurt for some time because they're contracting. Their economies are contracting. They don't have a substantial, real, productive economy. And so people are going to have to leave. They're going to have to go elsewhere to lower-cost regions and do real production of something as soon as we figure out what that's going to be.
Americans are not very good at anything except bombing people.
You take people for a generation and tell them that flipping real estate is
how you make
the way
money.
to use their talents. You have to start over. But so places like Las Vegas and the other very extreme bubble regions, there's these projects. I mean, these new condo projects are not going to. It's not going to go well. I mean, at best, they can cannibalize more marginal projects, and some people maybe move from one to another to get better digs. But people are going to be leaving the city. People are going to be making less money. The professionals that will be paying these prices are going to be making dramatically less money. Even executives, their bonuses are going to be less. So that's not good news for all that. On the other hand, I'll say that in terms of the rural-urban, ex-urban divide in this country in general, there is a source for some optimism because I think the sprawl got way out of hand and it's going to retrench, and we're going to see as commodity prices, energy prices go back. I still very much think we're in a secular bull market because of not only growth around the world, but chronic underinvestment in capacity and energy and mining and all of that. So gas prices will come back up. People are going to realize that the exurbs are dead. I mean, for the most part, some people will still be able to live there, especially if you work out of your home. But most people will need to move closer in. So I think the more close-in traditional suburbs and urban areas across the country will see something of a renewal. And you're already starting to see in some of the numbers, some of these housing starts numbers that they've trumped so much as green shoots. Well, that's not the ex-urban sprawl. That is multi-unit buildings, in town. And we have lots of those in Atlanta, for example. And yes, they're building too much too fast, of course. A lot of
usual.
A lot of that went up on the credit from a few years ago, and they're just finishing them off. And so they're going to languish for a while, I'm sure. But I would rather own those units than owning ex-urban tract homes that may be bulldozed for a lot of them. So, but it's hard to say what the time scale, when that's going to play out. So I wouldn't really make investment recommendations in terms of buying real estate for any of these. You could do it maybe if you had very deep pockets and a long holding period of 5 to 10 years. You might be able to make money on urban real estate.
Yeah. And I likewise have a similar viewpoint that the real estate market hasn't really bottomed yet, that we've got quite a few years to go. And looking at it in the big picture, I've discussed a lot of this theory in my new book, The Great Credit Contraction, where there's this liquidity pyramid, and the capital during a credit expansion moves up the pyramid into less safe and more risky assets, like these mortgage-backed securities or commercial mortgage-backed securities or auction rate securities. But then the psychology changes, and capital begins seeking safer, more liquid assets. And so it moves out of those into the Dow or into treasuries, or eventually into gold and silver. And that's where I have a few charts in my book where I look at the historical ratios of pricing different assets in terms of the monetary metals, which gets into really my specialty of monetary science. And when we look at the average American home, in 1974, an average American home cost, give or take, about 35,000 ounces of silver. In 1980, it bottomed at about 800 ounces of silver. In 2005, because of how large this bubble got, an average American home costs about 45,000 ounces of silver. And currently, we're at about 12,000 ounces of silver for an average American home. So while we've lost a very large percentage from 45,000 to 12,000, I don't see this market bottoming until you can pick up an average American home for between 500 and 1,000 ounces of silver. And that's really what the role of these monetary metals is it's to be able to perform these mental calculations of value or the pricing mechanism. Because we don't, the illusion, this Federal Reserve note illusion, is an unreliable measuring stick. And so we can't adequately price anything with it because it has no definition.
Right. For people who say that precious metals can fluctuate, it doesn't seem to correspond to inflation precisely or anything else precisely. Well, look at the Federal Reserve note. I mean, talk about unreliable. It's imaginary, completely imaginary.
Complete illusion.
Complete illusion, and it's certainly hard to make the case that more people, rather than fewer, will be subscribing to that illusion over the coming very immediate future. So I endorse looking at metrics like that, the gold and silver pricing of housing. I think we will go much more towards the other historical extreme that you mentioned.
Right, and so there's a lot of downside with it. Anyways, that'll wrap up our interview. We need to head out and go get a steak here in Las Vegas, and we had a very interesting time. It's been an interesting Memorial Day. I thought that Vegas would be a little bit busier than it is, but I guess that's just a sign of the times. And thank you, Aaron, for doing this interview with me.
Yeah, good to be here. Thanks.
Well, that ends the 37th episode of the RunToGold.com podcast. Thanks for listening. You've been listening to the RunToGold.com podcast, the premier source for applied monetary science on the web.